the acquisition fee is not just like gravy or pure profit in any way. When you're doing one of these deals, you're working hard for, 1 month, 2 months, 3 months, or longer. Another reason why it's not pure profit is that not every deal works out.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock solid underwriting. Whether you're a seasoned analyst, an up and coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey, welcome back to the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I have my good friend and business partner, Frank Patalano, with me. And today we are going to talk about how we make money as syndicators and why you would want a syndicator who makes money. Welcome, Frank.
I don't know if you saw it. If you're not watching the video, if you just listen on audio, I went, yeah, and put my hands up. So I thought it was pretty funny. I mean, the goal of this whole business, is to make money. The goal is to make money. I'm not saying that I'm going to be able to crush it or anything else, but we are putting a lot of time and effort into deals, and the goal is for our limited partners to make money, and there's a goal for the general partners to make money as well.
Yep. Yep. Fun fact, I am in business to make money. 100% selfish in that regard. And now we are going to talk about how we can make money, how we are upfront about making money. We're not doing anything shady. We tell you all our fee structures and what they are and how we collect them right off the bat. And we still try to get you your returns that we did not promise you but projected that we mentioned in the last episode. And so really we make money based mainly on fee structure and then at the end of the deal on the promote. And so the fee structure is the first fee that a GP team typically earns is the acquisition fee. So the acquisition fee is typically, and I've seen it anywhere from 1 to 5%, but I mainly see 2 to 4%, and I like to concentrate on the 2.5% personally. Um, and what this fee is going to be 2% of say the purchase price, or if it's going to be like a construction or a really big heavy value add where you're putting a lot of money into a deal, it could be like the total project price. And so for a $10 million deal, an acquisition fee at 2% is going to be what, $200,000, and that is spread out amongst the whole GP team based on whatever structure they have. So it's not like one person or each person is getting $200,000 for it. No,
Definitely not.
it's the whole GP team is getting it, and then they could be splitting that up amongst 4 to 8 people. And so that's the first fee that an investor, the syndicator makes.
So let me
Do you
let
have any?
me let me dig a little deeper into some of that. Um, the acquisition fee is not just like gravy or pure profit in any way. When you're doing one of these deals, you're working hard for, 1 month, 2 months, 3 months, or longer, uh, raising capital. Some people are using their net worth to sign on loans. There's a lot of different things involved that help pay for that acquisition fee and why it's needed and used. And another reason why it's not pure profit is that not every deal works out.
No.
So we recently had a deal where it was a very large deal, and the deal ended up falling apart at the end, and we still owed a bunch of people money. So the general partners, the active people on the deal, had to fork over about $100,000 worth of fees that were lying around. Attorney fees, broker, not real estate broker, mortgage lender application fees, inspections,
Third
appraisals, everything
party.
else. All those kind of things were paid by the general partners. Now the limited partners, the deal never closed. The limited partners that put all their money in got every single dollar back. But the general partners are taking a risk whenever they do one of these investments.
Yeah, and that's the main thing is they are taking the risk. You didn't even mention the earnest money.
Yeah, no,
The
no. There's
earnest money is when you put money down on a property when you're under contract before you buy it. Show good faith that you are actually trying to buy it and do everything you can. But when that money turns hard, that's no longer your money. Even if you don't close and you don't buy the property, you kiss that money goodbye. So the only way to keep that money is to close. And like Frank said, LPs aren't actively or are not in a deal until the deal closes. So if the deal never closes, the LPs get all of their money back. Um, Not so much on the GPs because they're like you said, they're forking over third party fees, lawyers, mortgage origination, everything, plus the earnest money. And there's been a lot of times when the earnest money we put in and I almost lost 175,000,
yep.
yeah, 175,000, 185,000 of my own money on the line. So whenever that acquisition fee did come in, it was sort of a relief. But um, I've heard of many people who have lost that much money. I personally haven't, but other people who have. So I mean, you start
That,
losing that much money, those acquisition fees aren't even going to cover anything.
that deal was a bigger deal, so I think the general partners lost around $600,000 in that deal total, split between seven people. So
And what would your acquisition fee been if you did close
um,
total?
it probably would have been around the same. Like I
So,
said, it was a pretty big deal. It was hundreds. It was over 400 units. Um, so yeah, maybe it was a 3% acquisition fee, so it was $1 million.
okay.
It was about a $33 million deal or so. So yeah,
Okay. So yeah, with a GP team who are making all the risks, you're like going get all of it or get go negative that much, and that is potentially scary. Um, but also the acquisition fee, what they do is he says you work for months raising capital and stuff, but you also have to source the deal. You have to underwrite the deal, which is what we do here in Ironclad Underwriting is we help people underwrite it to make sure that the numbers make sense. You have to walk the property, do your due diligence. There's a lot to buying a property. It's not just like, oh, I think I'm going to go buy a property today and slap a check down on the counter and walk out with keys. It doesn't work like that. You want to make sure that that building that you're buying is the what you think you're buying, and there's not going to be surprises later on. And again, that goes into another episode of where we get into like due diligence and stuff like that. But for acquisition fee, that's what that fee is for. So all the hard work that the team is doing trying to get that under contract and purchased. Now, assuming everything went right and you did acquire it, another fee that the GPT makes is the asset management fee. And what this fee is basically we as asset managers, as Frank and I on our own properties, we have weekly meetings on our properties, on each property we own. We're talking with a property manager. We're making sure everything's going right. We're making decisions on what we need to do when things go wrong, and so that's what our asset management role is. And for asset management, a typical fee is about 1 to 3%, and that is typically based on like the overall revenue generated for that property each month. I have seen, and I don't necessarily agree with, but I have seen people take a 3% asset management fee on the entire equity that they raised. Have you seen that?
No, I haven't seen that. Usually it's based on what your monthly income is.
Yeah, I know, but I've seen it based on the equity. And
Yeah, I
so
mean,
when
I
I,
guess it depends on how it's written, how the contract's written, the
yeah,
PPM and everything else.
and so I saw, suppose you raise $3 million, or no, 30, say you raise $30 million at 1%. What is that? 300,000
Yep.
a year. So that they're taking 300,000 a year for the life of the project. And they also raised 2 years worth of that fee. So they guarantee themselves 2 years of that fee.
I mean,
That
I'm not
that
saying
to
I
me
agree
is,
with it.
I don't agree with it. I
Yeah.
I I would never invest in a GP team that does that.
So,
That
so let's think
just
about it from a different investment vehicle. There are definitely brokers, financial brokers, where you have people investing in stocks and mutual funds. They
mhm,
do charge a fee based on assets under management. Like I said, I agree with you. It's you're you're managing, and it should be based on the income of the monthly,
mhm,
not the entire value of the
equity
project.
or equity raised. So yeah, it was definitely a questionable.
I
And
won't
I
call it illegal because it was based on whatever was signed in the private placement memorandum, but it's
yeah, it
definitely
was
not normal.
it wasn't legal, or it wasn't illegal, because I mean, you if you put in your PPM, hey, I'm going to take all your money and I'm going to go to Vegas and blow it all, and you sign it and you give me 100K, I can go to Vegas and blow it all, and there's nothing you can do because I said I was going to do it. So if you put it in the writing what you're going to do and how you're going to do it, 100% fine. It's when you start saying I'm going to do this and then I go to Vegas and blow it without you even knowing. That's when the bad stuff happens. So
So a couple things with the asset management fee. Um, it's it's not always evenly distributed amongst the team, just like the ownership of the GP is not always even. It's not usually evenly distributed. People have different roles.
yep,
So you might have, there are some deals I'm in where the asset management fee only goes to two or three people that are involved in the asset management.
mm,
And they're doing more than just the calls. They're actually running the numbers and having multiple meetings with the property management every single week. Um,
going on site
yeah,
and
yeah. So I consider asset management, you're managing the property managers, you know.
yep, managing the managers, managing basically the asset, make sure it's doing what it's supposed to. So um another fee, and this may or may not apply. It depends on if if the GP team has in-house property management. If they have in-house property management, they can or will take a property management fee. Typically, though, if they have in-house property management, it's going to be under a separate entity, even though it's the same people. It would be a separate entity, and it would be the same as if you hired a third-party property manager to look over your asset and run it versus you doing it in-house as a separate entity. So you're going to be paying those people anyway. Do you want to pay it to yourself through another entity, or do you want to pay somebody else? So and this one hits home to us because we are actively trying to create our own property management team to try and save money and feel we can run it better than the current one. Our options are limited, but that's where we are, and so that's what we're actively doing. So, um, you have something?
I was just thinking, those are what I would consider the acquisition fee and the asset management fee are the two main ways in which syndicators make money. Besides
Mhm.
this, besides the promote or the split, I'm sure you can think of a few other ideas of ways in which some syndicators might get paid, but it's not always every syndicator.
Yeah. These next two fees that I have seen, and it's like 50-50 if the sponsorship team or GP team does it or not. And these are like your capital event fees, which could be a refinance fee. They could actually spill out a refinance fee, or they could spill out a disposition fee, or they can just lump them on together and call it a capital event fee, which would cover both the refi and the sell or disposition. And typically those are going to be about 1 to 3%. For a refinance fee, it's going to be about 1 to 3% of whatever the refinance amount is going to be. And then at the disposition, it's going to be 1 to 3% of whatever it sells at. So, um,
So you would say 50%? You see 50-50? I haven't seen it that high, but
I've seen it about 50-50 where they'll have like a disposition fee, refinance fee. We've seen maybe 25%, and they call it as a capital event fee or something like that in the I guess the webinar pitch deck or whatever. Yeah, because when we discuss is like, does that include refi and the sale, or is that just a sale or whatever? But yeah, uh, from what I've seen, I would say 50-50, and it really depends on the experience of the operator. The more experienced they are, the bigger the team they are, the more likely they are to have that fee included. Um, the more inexperienced the team, the lower the fees should be. Um, but I've seen brand new green to people who've never bought anything before have a 5% acquisition fee, and they were going to bring home $200,000 for their first deal on a really small deal, and they didn't really even know what they were doing. So
some of that has to do with the different courses, gurus that are promoting different um, coaching programs.
yeah. And the thing with those is typically the coaches are going to be more experienced, and so they're going to do their deals a little bit differently, but the students are picking up on how the experienced people are doing them and not how they should be doing them as greenhorns. So
One fee that I see once in a while, and maybe it's part of asset management, maybe not, and this isn't for traditional multifamily, but more development, is they might have some type of like builder fee or a
yeah,
different type of management fee because I mean I have some partners that are general contractors and we all know the markup on rehabs and stuff like that. Well, I know one that he doesn't charge anything, but he probably could because his margin would be 25% if he was doing the rehab himself, and instead he's charging a flat like 7% just to keep the lights on in the business.
yeah, yeah. I have seen those, like the I guess project management fee or capex management or construction management fee. I've seen them. They're typically 10 to 15%.
Yep,
Um,
I the last one I saw was 8. So yeah,
and 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 these are and really it depends on your market you're in and where these people are having to come from, but these people, they're the ones who are arranging all of the subcontractors, making sure everyone's there, bringing in all the logistics of all the equipment and supplies you need, make sure everything is coordinated properly. So they should get paid for it as well. And I've worked with people who were wanting to charge me 15%. They start out at 10, and then they realize it's a bigger project than they thought, and so they keep bumping it up to 15. Um, but yeah, that's another fee. If you do all your construction or capex management in house, then that could be a fee for the GP team. Again, similar to the property management fee is or property management is if someone does do that in house, they typically do it as a separate entity. Um, but yeah, that is another fee. If you do bring it in house and you're not doing it as a separate entity, it is a good way to save money by not taking a fee at all and just doing it yourself because you want to get the best return for your investors, and one, if you've never done it before, you're learning, and so it's a good way to learn, do what you need to do, And that fee, I mean, that's not going to make or break you. The other fees and the other ways to make money or how the GP team makes money. So, um, I think the last way is not a fee, but this is through the waterfall structure. And again, we'll get into the waterfall structures in a later episode, but it's through the promote or the GP split after if you have a preferred return after that preferred return is met. And last time we talked about a preferred return going to your passive investors or your LPs. Say they get 8%, they're paid off. And now you split the profits, say 80-20, up to a certain amount. Maybe then it's 50-50 or whatever. 80% is going to your investor, 20% is going to the GP team, or 70-30 or whatever structure you decide. That 30% or 20% is going to the GP. That is now again how the GP team makes money. Um, Another way I didn't even mention is I am not going to invest in a GP team who doesn't invest their own money in the deal. And typically, the GP team, when they invest money, they invest in as an LP or limited partner. So they are also making money the same as the other passive investors as well. So that's a big green flag is if they invest a lot of money into it, especially if they're investing more than say their acquisition fee that they're going to earn. So what do you say, Frank?
So on the splits, I've seen the standard I usually see is 70% of the profit goes to the LPs and 30% of the profit goes to the GP. I've seen 80-20. I've seen 90-10. I think the higher the number that it needs to go, sometimes the tighter the deal. So, I mean, that's not always true, but it just worries me. So, I mean, if you have to give 90% of the profit to the LPs, how tight is that deal?
Another
Um,
thing though is when I see them that like that skewed, even at 80-20, I've seen 80-20, and that's straight off or straight out the gate. No preferred return or anything.
yep.
So
I've seen 65-35. I've seen 60-40. A lot of the bigger groups do 50-50 splits. And then there
so
was one deal
so
I
the
saw in California that the LPs only got 40% and the GPs got 60. I was shocked at that one.
oh, we had a friend who was investing in an overseas, I guess, hotel or whatever, and they were 70-30, 70 for the GP, 30 for the LP or something crazy like that. Remember that one?
I don't, but maybe, I mean, it's definitely possible.
The one in, was it Asia?
Oh, okay. Yeah, yeah. I didn't realize the splits on that. It's definitely
Yeah, that the hotel
in
or
Bali.
whatever, yeah, whatever he called them.
Yep.
So yeah, there you can get all sorts of different weird structures. Again, we'll get into that at a later date. But this is how the GP teams or syndicators make money. And if they are working with your investor money, you want the GP team to make money. Because if they're not making any money, they're not putting their heart and soul and sweat and everything into making this deal work. Because why would they if there's no incentive for them? So long as they work to get the returns projected for the investors, why not let them make some as well? So I mean, and I've talked with many investors before, and they think that the fees are too high, or they even wonder why there's even these fees there. And it's all because so the GP team is vested in the deal so that they work the hardest to make the most money they can to make the most money for you. So
Yeah, you got to realize that the general partners are not employees. They're not getting paid an hourly rate or anything else. They're putting in the work, and then there's a chance for them to make money.
yeah, yeah, they're not volunteers, that's for sure. So are there any other ways GP teams make money? Those are the main ways.
Yeah, I can't think of any other way on top of my head.
I can't think of any either. If you're listening to this and you make money in a different way, or you make another fee or something, put it in the comments, and we'll bring it up in a later episode. So,
Perfect.
you have anything else to say?
No, thank you, sir.
I don't have anything else. So again, this is Jason Williams. This is the Ironclad Underwriting Podcast, and we'll catch you next time. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.